This is a brief video on the relationship between military offensives that have taken place over the past decade on the part of the United States and what took place in the market on the date of those initial offensives. Now we're going to look at October 7th, 2001, the war in Afghanistan. We'll look at October 7th, 2002, the Horn of Africa. March 20th, 2003, the war in Iraq. March 19th, 2004, Northwest Pakistan. January 14th, 2010, the Yemeni al-Qaeda crackdown. And then March 19th, the events that took place in Libya. And we'll look at a couple of other events as well. Now you draw your own conclusions as to what impact these events have had. October 7th, 2001, Afghanistan. That was a weekend, so our first date is October the 8th. Market dropped a little bit, followed by a rally. Did that offensive have anything to do with it? October 7th, 2002, Horn of Africa. On the date of that offensive, you can see a brief drop in the market, but no major impact. When the offensive was launched against Iraq on March 20th, 2003, we did see a rally. Did it have anything to do with what was happening in Iraq? Perhaps. Perhaps not. Pakistan, 3/16/2004. Just so happens, here's the execution of Saddam Hussein, 12/30/2006. That was a holiday. Market opened on the first date there. Let's see, this is the 3rd of January, 2007. Did this drop have anything to do with it? The Yemeni crackdown. Market had already been in rally mode, followed by a drop to be expected. Here's the Libyan offensive, 3/19/2011. First date after that, 3/21. Osama bin Laden killed, 5/2/2011. Market was already at a high. So, is there any direct relationship? Draw your own conclusion. In my opinion, I don't think so. There are many other things that have a bearing on what happens in the market besides a military offensive. On August 29th, 2013, the United States is threatening to strike Syria. The market is currently at 1637. Will we see some kind of major impact on the market? Is that something for you to worry about as a trader? I don't think so. There are many other factors that go into how the market responds during periods of war, and it has very little to do, in my opinion, with the war itself. Just looking at market profile data, most recent market profile data taken from the high in August of 2013 to present, we have a low value area at 1652.25. The market has dropped to around 1624. Why? I'll just go back to the low on 624. To date, we saw very little volume taking place there at 1624. And our next, as the market moves back up, we see higher volume activity back at 1645. Here's where we've been. We dropped right into 1624 this morning. We're heading right back up to where we started on the 27th, the high at 1644.25. We're heading right back up there. Whether we'll get there today or not remains to be seen, but in the next couple of days, what could happen? Could it go up? Sure. Could it go down? Sure. What will it do? Whatever it does, it's not going to be a major drop in the market based on history. And we don't see some major market rally and or correction on the date of a strike. According to history, that doesn't happen. If it were to occur, if we were to have a major market correction, the pundits would probably say it had something to do with an attack. But according to history, that doesn't occur. Not in the last decade. So, draw your own conclusions. But now you've seen the history, and this is Rod Kusin and Spooman for Risk.